$1,000 a share, around $1 trillion valuation. What's Tesla really worth, and what's the price you'd be willing to pay to get back in?
Yeah, I was fortunate enough to see the company back when it was a private company and invested in late 2008, I believe, and sold a big chunk in 2013 and the rest when it reached over $1 trillion. And even though I believe in the company long term, I believe the right price is around 400. So I'm going to wait on the sidelines until I pick it back up at that price.
In this video, a very early Tesla stock investor has officially dumped all of his Tesla stock and is currently waiting on the sidelines for Tesla stock to dip below $400 per share before buying back in. Now, didn't I make a video about the idea of waiting for Tesla stock to dip a few years ago? I think it definitely applies in this case. Plus, we're also going to be looking at some new research from Morgan Stanley on Tesla. So, let's get into it. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks. Check out the links in the pinned comment below. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. You can also pick up some Tesla, Elon, and investment themed merch in the merch store, so check out the links in the pinned comment below, and thanks for your support. First, it's time to hear from an early Tesla stock investor. Now, fair warning, this may be a little bit difficult for some of you to watch. It's certainly painful for me to hear this guy saying he's waiting on the sidelines for Tesla to dip below $400 per share before buying back in. AKA, it's the last time he's ever going to own Tesla stock, in my opinion. Let's roll.
Ibrahim, welcome. I think you're saying you sold your Tesla position when it was at about $1,000 a share, around $1 trillion valuation. What's Tesla really worth, and what's the price you'd be willing to pay to get back in?
Yeah, I was fortunate enough to see the company back when it was a private company and invested in late 2008, I believe, and sold a big chunk in 2013 and the rest when it reached over $1 trillion.
First of all, mad props for investing in Tesla back in 2008, 2 years before the company's IPO. However, I want to talk about the decision to sell a large chunk of Tesla stock back in 2013 and the rest at $1,000 per share. Back in 2010, as we see here on the chart, Tesla stock was available in the $4 range, split adjusted. So why would you sell in 2013? Well, it turns out the Tesla stock effectively did about a 10x. So yeah, of course, metric, I've made 10 times my money. More than that probably, because 2008 was way before the IPO, would have been a much lower price. But it's made a 10x since it's gone public. Great time to sell, right? Got to lock in some of those profits, right? I mean, hey, you can't go broke locking in a profit. But just to add some historical context, 2013 was a year after the Model S was released and won every award ever. And this is the point where I started paying very close attention to Tesla as a potential investment opportunity. Prior to that, I was watching the company, but it's too early. You never know how things are going to go. But the fact that Tesla did what they said they would do and created such a compelling electric vehicle that it shamed the entire ICE industry was a point where I went, wow, there's definitely something here. So the first big dump of Tesla stock from this guy was after a 10x with Tesla at a whopping, call it $35 per share, give or take. As we know, as I record this, today it's over $800 per share. Now, the second sale happened at around that $1 trillion valuation, about $1,000 per share. And again, I mean, you can't go broke locking in a profit, so I'm not here to judge, but personally, I was still loading up with every spare cent at $1,000 per share, and $1,100, and $1,200, and $800, and $900, and $600. I don't care because I'm looking into long term, and I think we've got a very, very long way to go. I get the sense that the thinking behind these sales of Tesla stock was more along the lines of, wow, it's really gone up a lot. I guess I better lock in this profit while I can. And again, there's nothing wrong with that if your goal is to make some money along the way, but I tend to be forward-looking rather than backward-looking with my investment decisions. I haven't sold any Tesla stock at any point ever. I've been buying since early 2016. More than half a decade of relentless buying, zero selling. Clearly we have different strategies or a different opinion about what Tesla stock's worth and what the future of the company looks like.
Partially because I looked at something unique about that company, which is that 37% of its shareholders are retail investors, and that confluence of, let's say, the gamification of investment plus all that free government capital, plus Elon's constant reach out to these retail investors was buoying the stock to such a degree that I thought once the money ran out and the image of the infallible Elon Musk starts to wane, a lot of those retail investors will also start realizing that 79 times price to earning ratio is too exuberant. And even though I believe in the company long term, that's just too much for it. And I believe the right price is around 400. So I'm going to wait on the sidelines until I pick it back up at that price.
Where to begin? I guess first of all, I think some of the reasoning here, what we heard was, wow, there's way more retail investors in Tesla stock than normal, plus all the stimmy checks from the US government means obviously Tesla stock's gone up because all these crazy retail investors watching idiots on YouTube are going all in on Tesla stock rather than actually looking at the company's valuation. Therefore, when the money runs out, the stimmy checks are gone, Tesla stock's going to crash, so I'm going to wait until it crashes down to $400 per share. And while it is technically, theoretically possible that Tesla stock could come crashing down to $400 per share as retail investors go, hang on a minute, oh, that doesn't tick the right box in my spreadsheet after all, I better sell it. I don't think that's going to happen. An alternative explanation here is maybe, I know this is a very controversial and out there idea, but is it possible that the retail investors in Tesla have seen something that the Wall Street dimwits have not? Is it possible that a company like Tesla is so hard to fit into a box, to label, go, that's one of those. Oh, that's right. Which cell do we stick this in our spreadsheet? Oh, cell D39. That's one of those, a D39. Great. Okay, so how do we value it? Okay, it's overvalued. Is it possible instead that retail investors with a slightly different perspective and far less intellectual prisons in terms of how to look at a company are a little bit more free to look at what Tesla's actually doing, what's actually happening in the marketplace, and are noticing some opportunity, some value, some future prospects that Wall Street overall are missing? I think that's actually the case. Of course, I could be wrong, but I am making a multi-million-dollar bet that I won't be. What do you guys think? Is it possible that retail investors have some insight and some awareness into the future of Tesla that Wall Street are missing? Or should Tesla come crashing down to $400 per share when all the retail investors decide that Tesla is a massively overvalued company?
Okay, why 400, and put that in light of the challenges that we expect the company to be facing this quarter and for the rest of this year? I mean, why doesn't Tesla get Netflixed, right? Given that there are competitors who, I mean, the threat is always competitors are going to get into the space and have success. They haven't really in a significant way yet when it comes to EVs, but they have in streaming, and that eventually has caused a re-rating in Netflix. Why won't that happen to Tesla?
I'm not really sure comparing Tesla to streaming services is a great analogy, in fact, pretty terrible. How do streaming services get content? They have two techniques. They either create it themselves, very expensive, or they buy the rights, they license the content, and then they either have exclusive or shared rights to actually show that particular show. Shout out to Jerry Seinfeld, still getting paid many tens of millions of dollars every single year for his contributions to Seinfeld. So in theory, a well-capitalized streaming company could come out of absolutely nowhere and start creating content and or licensing content, and bam, where's your competitive advantage? How do you avoid that? How do you avoid a competitor buying exclusive rights to Rick and Morty or name your other show? In terms of streaming, you get a little bit of capital, you're off to the races. If you get exclusive rights to a particular show that people want to watch and you're the only platform it's available on, you're going to have some customers. However, when it comes to automotive, electric vehicles, and energy products, large-scale manufacturing of complicated objects, things are a little bit different. It's not just a matter of throwing money at the problem and effectively solving it. You also need incredible engineers. You need to innovate in terms of manufacturing. You need to understand how to drive costs down making these products, otherwise you go bankrupt. Tesla has huge competitive advantages in terms of software, thermally managing batteries, manufacturing, on and on and on and on and on. We keep hearing that the competition is coming, but most people saying that don't really seem to understand what's involved in the competition actually coming. They've got to climb multiple Mount Everests in a row without dying. Very difficult challenge.
It will happen at Tesla. I don't know if it'll be crushed to that degree. And even if it does, I'm long-term bullish on Tesla. So even if it goes below 400, I'm happy to hold it again for the long term like I did, because I see it breaking through the trillion and $2 trillion mark in the long term. But we're talking about maybe even 8 to 10 years ahead, and I'm happy to be a long-term holder of the stock.
Some interesting comments here. Very bullish on Tesla over the long term and believes the company will exceed a $3 trillion market cap over the long term, about a quadrupling from where we are today. Not sure exactly what he means in terms of long term. Could be looking at close to a decade. And don't get me wrong, I agree. I think Tesla will more than quadruple over that period of time. But this gives a little bit of context. Clearly, he's going to be chasing bigger returns in a shorter period of time, hence selling Tesla stock. Personally, I suspect, per my Tesla stock price targets available exclusively on Patreon, check the card in the corner or the link in the pinned comment to join to gain access. Personally, I believe Tesla stock will exceed a $3 trillion market cap somewhere around the middle of the decade. Worst case scenario, it's a little bit later. Best case scenario, a couple of years from now. Of course, I could be wrong. It does happen sometimes. But I think this is the key difference. Our friend here believes, yep, maybe over the long term, maybe it takes a decade for Tesla to get to that $3 trillion market cap. Personally, I believe it is much sooner than that. However, I don't really care about the next couple of $1 trillion. I'm looking out 10, 15, 20 plus years into the future, thinking the impact of robotaxis, the software component, Tesla's ever expanding fleet, their average monthly revenue per user, plus the massive impact of the Tesla bot and Tesla scaling their energy business, including generation storage and, importantly, supply. Tesla's energy software, the energy distribution capabilities, massively underrated.
There are 70 models of EVs entering the market, both on the low end and the high end of the market. So the association between Tesla equaling electric vehicles will start to dilute over time as consumers have more options.
Yes and no. Personally, I believe over the longer term, sure, consumers will realize that Tesla aren't the only company making EVs. However, I suspect that Tesla is still going to maintain the reputation for being the only company that makes compelling electric vehicles. Tesla has such compelling products and such a huge, unassailable lead that I can't see anyone producing superior products to Tesla for comparable prices anytime this decade, if at all. So absolutely, there'll be semi-decent electric vehicles available to consumers, and at some point consumers stop equating Tesla is the only EV on the market. But much like today, Apple is still lauded in terms of consumer electronics products. Apple fanboys and fangirls the world over, as soon as there's a new model, they immediately line up. iPhone equates to smartphone. Of course, on paper, there's plenty of competing products that even have better specifications. But when you talk about consumer preferences, expectations, and perceptions, I think Tesla has already positioned itself to have that same kind of perception that Apple does today in terms of smartphones and other consumer electronics. Of course, time will tell.
And as we know, their battery division did great, but their solar division, due to capacity constraints, did very, very poorly. And those government subsidies that they sell over in Europe will obviously also diminish over time if, more manufacturers are producing EVs. So they don't need to buy those government issued credits anymore from Tesla, which is a big part of their revenue, as you know.
Yeah, Ibrahim, looking at the issues of supply and demand, I know this quarter we'll see the impact of the shutdown of the Shanghai assembly plant. And then, of course, on the demand issue, we have this question of how much consumer spending will pull back with the potential recession. How persistent do you see problems that are similar to the Shanghai plant shutdown? And how resilient do you think that the Tesla consumer will be?
I'm shaky on the Tesla consumer long term, just because the brand is getting a little tarnished. The association of it being a symbol of the future is getting muddled with a lot of the erratic behavior from the founder.
I think this is a really, really poor read. Again, this is one of those yes and no kind of comments. In fairness, there is a small subset of consumers out there who rely on the mainstream media to tell them what they should believe and think. These people are also known as morons. And yes, there's plenty of morons out there. However, the compelling nature of Tesla's products themselves can overcome this almost entirely, not completely. Of course, there's going to be some woke morons who want to virtue signal, I sold my Tesla because Elon's a dickhead. Fuck you, Elon, never buying a Tesla again. Meanwhile, in the time it took them to make that angry tweet, 162 new orders for Tesla vehicles have just come through on the Tesla websites globally. So you see what I'm getting at, right? How many consumers out there said, hey, you know what, I'd really love to get one of these iPhones, but I heard Steve Jobs is a cunt, so I'm not going to buy an iPhone. I'm going to buy whatever else is on the marketplace. Some, but not many. I think this is far less of an issue than most people expect. Imagine being a consumer whose number one criteria for buying a new vehicle is safety, and you actually do your homework in terms of safety. You're smart enough to, instead of being easily manipulated by advertising and tricked, you look at the actual data and you discover, Tesla vehicles, safest ever tested, lowest probability of injury in an accident. I want to keep my family safe. I'm going to buy a Tesla. Do you think this particular consumer, whose number one preference is safety, and of course, every consumer has a different preference, but in this case, do you really think they go, I heard in the mainstream media Elon said something mean, so I'm going to buy one of these cars, having done my research, knowing full well they're far less safe than a Tesla, and I'm going to have my family in a less safe vehicle just because I heard something about Elon and I decided I don't like him. There are some consumers who actually are that dumb, but I don't think they're the majority. The idea that the erratic behavior of the CEO is going to meaningfully impact Tesla's sales and growth as a business, to me, is truly absurd.
But regarding supply constraints, I can't speak to more variants of COVID or what that's going to do or not do, but BYD seemed to also suffer from shutdowns and still deliver a massive amount of cars, beating Tesla's Model Y and Model 3 in China. So that baffles me a little bit, and I'm curious to find out how that was able to happen. The whole industry, just so you know, is going to have a massive supply issue over time, because we're transitioning from a fuel-based economy to a mineral-based economy. So that means that there's a whole new supply chain that has to be built to allow us to build these storage capacities, these semiconductors that are going to fuel this new economy. And, there's just, I've done the math, my firm Full Cycle has done the math on this, and even something as simple as copper, if everything goes perfectly, we'll still have a 20% differential between supply and demand in the next 8 years. And that's one of the most simplest, most abundant minerals out there, but we can't transition as fast as we want to without figuring out how to rejigger our supply chain and find new mineral capacity.
This is definitely a reasonable point. Won't be easy. There's going to be some major challenges in terms of supply chain and resources, including the stuff that's going in the battery cells in the electric vehicles. But a couple of things I'd like to say on this. One, believe it or not, Tesla is actually aware of these challenges and are doing their best to mitigate them as much as possible. Second, Tesla's in the strongest position to navigate through these challenges, given the fact that they've been looking into the future further than anyone for longer than anyone. And the third point I'd like to make here is, can you imagine that? Disruptive, innovative technologies, the extinction of the internal combustion engine, and the adoption of an entirely new form of propulsion. What are the odds that this might include some very big challenges in terms of supply chain, logistics, materials, given it's brand new technology that's scaling up to ridiculous volumes? I mean, kind of comes with the territory, right? And now a new research note from Morgan Stanley. And before we get into it, I just have to once again bring up their EPS estimates. Every time I look at these, I just scratch my head and wonder, what the actual are you smoking? And please, can I have a hit? We can see here in blue, we've got 2022, 23, and 24 EPS estimates. Got consensus up the top, prior consensus estimates, and Morgan Stanley's own modelware EPS estimates. I just do not understand what the hell is going on here. $10.12 of EPS in 2022. I mean, okay. The thing that really puzzles me, however, is the mere, give or take, about a 10% increase in EPS from 2022 to 2023. We've got $11.57 of EPS in 2023. Even the consensus opinion of $13.28 is absolutely absurd. Tesla's going to come in close to double these numbers. I don't understand where these are coming from. In 2024, we got $15.99 of EPS. Consensus, not even $18. It ain't going to age well. Please, set a reminder to check back at the end of 22 and the end of 23 and the end of 24. And let's see where Tesla's EPS actually came in. I bet closer to double these numbers than these numbers. Quote, Tesla's becoming a mass market player. That's good and bad. This will be interesting. Morgan Stanley with a $1,150 per share price target for Tesla stock. Quote, Tesla will exit 2022 at a nearly 2 million annualized run rate. That is true. They should be double that within 2 to 3 years. That is also true. I just want to take a quick moment here. We'll talk more about this later because there's some contradictions in this Morgan Stanley note. All right. Morgan Stanley have just said, they're on the record, we're literally looking at it on screen right now. Tesla will exit this year with around 2 million annualized run rate. They will be double that, as in 4 million within 2 to 3 years. Now, if you're really bad at math, it's 2022. So 2 years would be 24. 3 years will be 25. So let's just say, give them the benefit of the doubt, it's not until 2025 that Tesla's at an annualized rate of about 4 million units per year. Morgan Stanley's current estimate for Tesla in 2030 is just 8 million units. So their expectation is that Tesla's going to double their production from now in the next 2 to 3 years, but then it's going to take Tesla the rest of the decade for one final doubling. Okay. But size brings complexity in autos and exposes the company incrementally to macroeconomic and geopolitical risk. It's okay for Tesla to be the best EV company with a stock that takes a break. Following better than expected Q2 results, oh geez, how many times has Tesla posted better than expected quarterly results? Almost every quarter in the company's history. Why does that keep happening? I'll tell you why, because Wall Street keeps underestimating Tesla and not learning their lesson. We make a number of adjustments to our earnings forecasts while, inexplicably, leaving our price target unchanged, $1,150 per share. The bull case is $1,600 per share, and the bear case price target $500 per share. Funnily enough, we've just heard from our friend who thinks Tesla's going to be crashing below 400. Morgan Stanley's absurd bear case is over that level. What's changed with our model? Unit volume. No change for 2022 or 2023, which stays at 1.37 million for 2022. I mean, yes, they'll get there and then some, but hey, I'm not going to hate too much on these folks. There's a little bit of uncertainty around China. 2 factories ramping up, I get it. Could go either way. It's hard to predict this over the short term. The initial ramp of new factories plus the COVID shutdowns in Shanghai, which nobody would have seen coming, it's hard to know. I'll give them a break here, but I am here to tell you Tesla is going to absolutely hit 1.98 million units out of the park in 23. I mean, this is going to look like a joke. They're off by double-digit percentages on this one, in my opinion. And here's where the respect goes straight out of the window. Our end-of-decade volume forecast remains unchanged at just over 8 million units. By 2030, we estimate Tesla captures just over 20% share of the global battery electric vehicle market. Now, a couple of things here. One, Why are they talking about a global battery electric vehicle market? In 2030, the only vehicle market is the electric vehicle market. By the end of this decade, in my opinion, EVs represent 80+% of new vehicles. In other words, forget ICE. It's not even worth talking about. EVs are the entire market, the end. Including 25 to 30% of the battery electric vehicle market on an ex-China basis. I think the key takeaway from this is Morgan Stanley are massively underestimating how fast Tesla can ramp production. And maybe part of the reason for that is because they're massively underestimating how big the EV market will be in 2030. Automotive gross margin. And this is a serious head scratcher. Their 2023 automotive margin estimates now at 23.8%. Now we saw just a quarter ago, Tesla's around that 30% mark, and then there's the fascist shutdowns in Shanghai, losing 100,000 units of production, give or take, plus 2 new factories ramping, which are obviously going to have a temporary negative drag on margins. But bro, what are they expecting Berlin and Austin next year to produce about 12 units combined total? These estimates also won't age well. And I'm sure part of their reasoning is, material supply chain costs, blah, 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 they're going up. But obviously, Morgan Stanley have failed to account for Tesla proactively raising prices to account for these price increases. While our forecasts may very well prove too conservative, nail on the head, at least they acknowledged, still not going to stop me roasting them because I can say today they are way too conservative already. Our forecast allows for a catch-up impact of input costs relative to Tesla's pricing actions, a lower mix on an incremental 500,000 units, and other potential disruptions related to ramping Berlin and Austin. We note we raised our operating margin for 2023 substantially to 14.9% versus 11.5% previously. Substantially is an understatement. That is a massive increase. Due to the higher gross assumptions and lower assumptions for OPEX, R&D, and SG&A. Tesla has been exhibiting far better OPEX leverage than we had anticipated. Fancy fucking that. Tesla, more capital efficient, more operating leverage than some of the Wall Street geniuses expected. Who could have seen this coming? Well, clearly not Wall Street, but pretty sure there's been a bunch of people on YouTube and Twitter who've been calling this for literally years. Remember, we just saw earlier in this note, Tesla blew expectations away for Q2. Again, they always do this. And now we also have more confirmation that Wall Street continue to underestimate Tesla from every possible direction and angle, being surprised that Tesla has better OPEX leverage than they had anticipated. Cash flow. Our revised free cash flow forecast for 2022, 23, and 2025 are $7.2 billion, $19 billion, and $28.1 billion respectively. My free cash flow estimates are absurdly ahead of this. Again, if you want to see all these details, check out my Tesla valuation model available exclusively on Patreon to supporters at the investor level and above. Click the card in the corner or the link in the pinned comment. Small offsets to Tesla network services, software as a service. Reduced medium and long-term attach rate and monthly ARPU, average revenue per user, to 60%, previously 64%, and $140 a month, previously $150 a month, to reflect greater macroeconomic conditions, affordability, and increased competition in the mobility space. Without increased transparency from the company on its recurring/highly reoccurring revenue streams, it may be difficult for investors to give the credit for the SaaS opportunity. That's right, Tesla, please tell us exactly what to stick in our spreadsheet, otherwise we don't really know what to estimate, so we're just going to massively underestimate because we're Wall Street, we're very conservative, and that's how we roll. We'd rather be completely wrong to the downside than ever overestimate anything. Other thoughts on shares at over $800. We are pleasantly surprised that the market has stuck with Tesla in the face of geopolitical and macroeconomic uncertainty. So I think the translation here is that Morgan Stanley are pleasantly surprised that the market hasn't overreacted and panicked to things that are completely irrelevant to Tesla's business, their lead, their technology, their wait times, their profitability, their margins, and so on. The company's estimated beating and self-funding attributes appear to be further separating the company from other EV players. Our message to clients is that, quote, Tesla in our view is still in the must-own category for any energy transition/battery electric vehicle portfolio. Personally, again, this is just my personal opinion, I personally believe that Tesla should be in addition to any portfolio that involves a goal of increasing your capital. But hey, that's just me. However, the company should not be seen as invincible to the rapidly changing consumer environment. As Tesla becomes a larger company, expanding capacity further to what we see will eventually be 10 plants by the end of the decade, the company is, at the margin, exposed to the forces that impact mass market auto OEMs. Now, admittedly, I see where Morgan Stanley are coming from here. You know, if Tesla's selling 20 million vehicles per year and there's a recession, sure, they may see a marginal impact on their sales. But at their current scale, with their current wait times and their current compelling vehicles, this is all completely irrelevant. I've said it before, I'm going to say it again. Tesla's going to sell every fucking vehicle they make for the next decade. Doesn't matter what they're doing. They're going to sell all of them. They can't make enough vehicles to satisfy demand today, and that is going to be true for the next 10 years straight. As Tesla grows its volume base, we believe it may reflect the limitations of the broader EV supply chain that are not completely within Tesla's control, including the dependence of lithium and cathode material refining and processing in China. So let's just jump in here. What are the odds that Tesla is aware that this is a bottleneck, and what are the odds that Tesla's been thinking, how can we blow open this bottleneck? How can we ensure that we don't get stuck and held back by these future bottlenecks that we know are on the horizon? I've got a funny feeling Tesla is not only aware, but they got some plans up their sleeve. Moreover, A host of unsustainable ESG/CO2 and economic factors that define the current battery supply chain are overdue for a painful re-architecting that could present a lull in EV company earnings expectation categorically through mid-decade. What a mouthful. By the way, I do want to point out there is a little bit of BS that's going to be a negative drag. However, at the same time, EVs are new technology, cost declines, battery cost declines. I mean, bro, overall, by the end of this decade, Tesla will be able to produce a compelling vehicle that's comparable to a Model 3 or Y for about, give or take, maybe 18, 20 grand, maybe even less than that. If you're a little bit confused about how this works, check out economies of scale and Wright's law. And maybe if you want to go a little bit deeper, the predictably declining costs of lithium-ion batteries. At the same time, we believe developments in vehicle autonomy may progress far slower than current market expectations through 2023 and into next decade, leaving Tesla shares exposed to a reset risk around FSD and autonomy. Now, I don't expect this to be the case, but it is possible. But again, as a long-term investor, I don't really give a flying fuck if Tesla solves autonomy in 2025, 2030, or 2040. I just care that their lead is unassailable. It's not about when they get there, it's just that they get there first. This is not a comment so much on Tesla's autonomy efforts, which we believe may prove successful over time, but believe the broader industry efforts around autonomy, while both notable and profound, are likely to miss expectations of the market, in light vehicles at least, due to technological and regulatory factors. Definitely possible. Valuation. Our $1,150 per share price target for Tesla stock, our $500 bear case, and our $1,600 per share bull case are unchanged. We believe trading floor value for Tesla in the second half of the year is near our bear case. In other words, Morgan Stanley not expecting Tesla to dip below $500 per share, worst case, this year, which will put the company on approximately 12 times EV EBITDA and 24 times PE on our 2025 numbers, which are dramatically under where they'll actually be. Given the breadth of Tesla's business portfolio, it is not possible to solve for one specific variable like volume. However, we rarely get pushback on our 8 million units in 2030 estimate. In other words, most people are, 8 million, yeah, that's fine. There's very few people going, bro, are you serious? They're not going to get even close to that. And more frequently hear feedback that it should be well above 10 million units. Seems like some reasonable feedback. I've been ripping on these guys from day one. I mean, come on. 8 million in 2030? They've got to be high. We note that our $1,150 per share price target is based on just over 8 million units by 2030, which supports approximately $600 per share of core automotive value, with the remaining $550 per share driven by recurring revenue and other services from the platform. Hypothetically speaking, if Tesla hit 20 million vehicles per year and everything else remained the same, you'd be able to double Morgan Stanley's price target today. Their 12-month price target then will be $2,300 per share. Simple math, just double it. It's always interesting to hear the thoughts and opinions of people when it comes to Tesla stock. Pretty stunning to hear an early Tesla stock investor dumped most of his stock in 2013 after a huge run and the rest of it at $1,000 per share and now expects, not hopes, but expects Tesla to fall below $400 per share, at which point he'll buy the dip and be happy to hold the stock long term because he believes Tesla could easily get to a $3+ trillion valuation over the longer term. In my opinion, the guy's never going to own Tesla stock again because $400 per share, get fucked, mate. Maybe after a stock split. Of course, I could be wrong, but I do find that highly unlikely. I mean, that is a pretty absurd comeback. I think if Tesla stock got to $600 or less, a lot of new buyers come in at $500, everyone's like, bro, what? Nah, I'm buying now. But you never know. Morgan Stanley continue to underestimate Tesla and acknowledge that they may in fact be underestimating Tesla. Hey, better than nothing, right? It was interesting. This was the first time I've heard Morgan Stanley actually acknowledge they get very little pushback on the 8 million units estimate. In other words, just about every investor thinks that's totally within Tesla's reach. I am still, however, waiting for the day that these guys grow some balls and actually put some more realistic estimates out there. At this point in time, it's just an absolute head scratcher. They expect Tesla's going to be around 4 million units of capacity by mid-decade. In the next 5 years, despite the fact that in the preceding 5 years they've added about that amount of capacity, they're just going to do the same amount again. How do we draw that conclusion, Morgan Stanley? Throughout the company's history, Tesla's production growth has been increasing exponentially. Yet suddenly and inexplicably, Morgan Stanley expects suddenly, come mid-decade, Tesla's suddenly going to stop growing exponentially and now just go into a linear growth mode. Inexplicably. Of course, time will tell. We'll just have to wait and see how things play out. But the theme of today's video, we've just seen a couple of experts massively, and I mean massively, underestimate Tesla again. I'd love to know what you guys and girls think in the comments below. Could Tesla stock ever get below $400 per share? Obviously not factoring in a split. I just mean based on today's current valuation. In other words, will Tesla's market cap ever reach $400 billion or less, give or take? And a quick heads up, the latest Patreon Q&A has just dropped. Loads of juicy content, including my thoughts on Andrew Tate, Elon Musk's relationships, and prolific procreation, Tesla, advice for people just starting out, how to increase your income, and loads more. So, see you over on Patreon. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. And if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.